Hey everyone, hope you've had another great week. Welcome back to the PIMD podcast. I'm Dr. Peter Kim, your host. And this week we're going to tackle a concept that is so important when it comes to investing, especially real estate investing. And I know it can be misunderstood, but again, it is so important and it'll change what's in your pocket at the end of the day. I know we care about that. It's this concept of depreciation. And I know that might feel like some sort of dry tax term, but if you're a physician with a high income, and you're interested in real estate investing at all, depreciation, it might be the most powerful tool that you don't know how to take advantage of yet. This week, we're going to break it down as simple as we can and give you everything you need to know to get started and make the most of it. So stay tuned.
Welcome to the Passive Income MD podcast, where we talk about creating your ideal life through multiple streams of income. If you enjoy hearing about this stuff, make sure to hit subscribe. Now let's get on with the show.
It's been another incredible week. Busy in so many ways, challenging, and it's crazy sometimes how fast life goes. I think when you're busy and you're challenged, life goes even faster, and that can be a scary thing, but maybe that's a good thing. When there are challenges, you want to get through it as fast as you can. Now, it was a crazy week for me because I ended up selling one of my properties, and there's so many considerations when you sell a property, and a lot have to do with taxes. Now, I don't typically like talking about taxes, or I definitely don't like thinking about taxes, which is why I've hired a great team of tax professionals. But if you're going to be a responsible adult, you're going to be a responsible investor, it's important to at least know some of the concepts in some detail to know how it can work best to your advantage. Because at the end of the day, you make the decisions that are best for you and your family, and you don't want to outsource that completely to someone else. One of those concepts is this concept of depreciation when it comes to investments. So let's talk all about that. It's the IRS's way of recognizing that the physical part of a building, not the land, just remember it's the building, wears down over time and loses value. Now, if your property is appreciating in real life, like the properties that are out here in Southern California, of course, those building materials are technically breaking down over time. The value of them is actually appreciating in value, but the IRS still allows you to show a paper loss and deduct that for tax purposes. So let's say you buy a rental property for $500,000. This is just a number, for example. Let's say you separate the value of the building from the land. Let's say $400,000 of it is depreciable, meaning that you can actually depreciate that because that is the value of the building. Now, the government allows you to spread that over 27 and a half years for residential property, and you divide that evenly, and that gives you a tax deduction of about $14,500 per year. And you don't have to spend any extra money for that. That's just for being in the investment. Now, why does that matter? Because it can offset the income you're making from your passive investments, from the rent that you're getting from other investments, from the syndication deals that have given you distributions or have exited and made you money. So it's possible that you could actually earn income passively and still show a loss on paper. That's the magic and the power of depreciation. Because when you show losses on paper, you don't pay taxes. And I have to remind you here, I am not a tax professional. I'm just trying to share what I know of this topic. And if you want to figure out how this works for you, make sure to consult a tax professional before doing anything. Now, let's connect the dots on this. You're a physician. You're in a high tax bracket. You're probably bringing in solid clinical income from either W-2 or 1099 work. I know a lot of physicians. In fact, the majority of physicians are employed physicians these days with the W-2. Now, if you also own rental properties or you invest passively in syndications, depreciation allows you to reduce the taxable income from those assets. So again, it can create a paper loss that you can use to offset other income. Now, in some special cases, for some of you, if you qualify as a real estate professional or you use something called a short-term rental loophole where you materially participate in short-term rentals, that paper loss can even go to offset your day job, your clinical income, your active income. Now, I've talked about this on different podcasts, so look out for that if you're interested in finding out more about that. And that's crazy because if you qualify for this, depreciation could actually reduce the taxes you pay on your day job. That's a huge deal. Now, how do you make the most of depreciation? This is where you might hear of the terms cost segregation and bonus depreciation. There's a study that you can do. You pay a company and they do something called a cost segregation, where they break out parts of the building. They actually itemize everything, the appliances, the flooring, the fixture. And again, the government allows you to depreciate them at different schedules, meaning that some you can depreciate over 5 years, some you can do over 7 years, some over 15 instead of the 27 and a half years that we talked about before. And if there's something called bonus depreciation that you can take advantage of, and it's in effect, which is still is today, but is kind of dropping off, you can deduct a large portion accelerate those costs in year one. Now, depending on when you're listening to this, there is legislation that is being passed through Congress right now that brings back 100% bonus depreciation, which allows you to accelerate a lot of these losses that you created using cost segregation and push all that into the first year, creating massive losses on paper. That's a huge upfront deduction that can shelter your cash flow or offset other gains.
Hey everyone, this is Peter Kim. I've got some exciting news for those of you thinking about taking your career beyond clinical medicine. PIMD Con 2025 is officially happening this September 25th through 27th in Newport Beach, California. Now, this isn't your typical conference. It's designed specifically for physicians like you, those who are exploring side hustles, thinking about starting a business, or wanting to learn how to invest in passive real estate. Now, at PIMD Con, you'll hear from top experts, investors, and entrepreneurs who've been in your shoes and are ready to share what works. Now, we built this event with you in mind, with tailored tracks focusing on real estate investing as well as entrepreneurship. So whether you're just starting out or looking to scale, there's something here for you. And if you can't join us in person, we've made it easy for you to participate virtually from anywhere. Now, if you've been thinking about creating more freedom in your life, financially or professionally or time, now this is your chance to take the next step. So head over to PIMDcon.com to grab your ticket. I hope to see you in Newport Beach. It's going to be an incredible weekend of learning, connection, and inspiration.
So let's say you invest in a syndication, you receive a $10,000 distribution. Because of accelerated depreciation, maybe your K1 that you get, the tax paper that you get from your syndication, it actually might show a $15,000 loss. So you got paid that $10,000, but on paper, you still lost money. That's the power of tax efficient investing in real estate. And that's a great example of it. Now, I know this topic can be confusing, and it's been confusing for me for so long. So I created this free resource for you called Depreciation Demystified, a quick guide for busy physicians. It's just like a 1-pager or 2-pager that breaks down everything about depreciation in plain English, including bonus depreciation, cost segregation, and then what happens when you sell. You just go to the show notes where you can go download that for free, or go to the corresponding blog on passiveincomemd.com and you can download that. But let me tell you something that many people don't talk about. It's that depreciation, it can be a gift up front, but it's not a permanent one. Like when you sell the property, the IRS comes back for a piece of it. They know you deducted it. So there's something called depreciation recapture. It taxes the depreciation you claimed, often up to about 25% of that. So let's say you claimed $100,000 in depreciation. When you sell, you could owe about $25,000. So that's 25% of that in recapture taxes. That's separate from your capital gains tax. It's something that the IRS wants back. A lot of investors are surprised by that. Nobody tells them that depreciation has to be accounted for when you sell. But if you know that, you also know that there are strategies to avoid paying that. You don't have to take that tax hit right away. Now, there are a couple ways to defer or eliminate that recapture altogether. You can do something called a 1031 exchange, where you can sell one investment property, roll the profits into another property, like a similar one, and defer your taxes. I've done a whole podcast series on this too. Go ahead and check it out. Like it resets your depreciation schedule and continues the cycle on. So you kick that can down the road. Number 2, you can also invest in something called opportunity zones, where you invest in certain areas that have been designated as quote unquote opportunity zones, where the government wants to incentivize redevelopment, and you can potentially reduce or eliminate some taxes. Or just so you know, there's something called a step-up basis at time of death. So if your heirs or the next generation inherits the property, that cost basis resets. So it could potentially wipe out all depreciation, recapture, and capital gains, which is an amazing benefit. And that's why real estate in so many ways can create generational wealth. So yes, depreciation is taxed later, but if you smartly plan, you know that it could come to bite you in the end. That gives you leverage. So here's an example of a physician who used this smartly. She's an anesthesiologist with 1099 income. Maybe she buys a short-term rental for, let's call it $750,000. She hires that cost segregation firm that we talked about that creates that cost segregation, does all that itemization. And then in year 1 is able to claim $200,000 in bonus depreciation. That's absolutely possible. Now, she actively manages that short-term rental, uses the short-term rental loophole, and qualifies as a material participant, almost as an active investor. She can use that deduction to offset her clinical income. Think about that, $200,000 to offset your clinical income. Now, a few years later, she sells the property, but uses a 1031 exchange to buy a larger building. No tax bill, new depreciation schedule, more cash flow. And this is how physicians can turn one property into a long-term financial freedom strategy. Now, there's some mistakes that physicians make with depreciation. So before you jump in, here are a few pitfalls to avoid. Number one, just forgetting to depreciate. I'll tell you, some accountants miss this. This is why you need to advocate for yourself. You need to understand this. So don't let this happen. Number two, you're not planning for recapture. You got to understand your exit strategy on the end of this. Number three, maybe you assume all your losses offset your income. But just remember, there's a whole difference between active and passive income and active passive losses. You have to meet certain IRS qualifications for that loss to offset your active income, not just your passive one. Now, if you work with a great CPA who understands real estate and physician tax planning, it can make a huge difference when using this strategy. So just so you know, depreciation, it's not like a loophole. It's what most smart and savvy real estate investors use. This thing is designed to reward people who invest in housing and infrastructure. It's an incentive from the government. So if you're serious about real estate investing, especially as a busy physician, understanding how depreciation can work can save you tens of thousands of dollars in taxes each year and accelerate your journey to financial freedom. It's not complicated once you learn the basics. I hope this has helped you do that to help understand the basics of depreciation. Now, if you want to dive deeper into strategies like depreciation, tax planning, how to invest confidently, consider checking out Passive Real Estate Academy. That's our signature program where we take physicians from zero to little knowledge to a place of confidence when you invest in passive real estate investments. So you can build up another income stream, ultimately build freedom without putting in more time and without giving up your career. You just go to passiverealestateacademy.com to check that out. So until next time, I hope this was helpful for you in some ways and demystified depreciation for you. You did amazing if you stuck around till the end of this. Thank you so much, and let's talk again soon.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.